Hi guys, welcome back to another episode of Singaporean Talks Money. So, when we invest, should we dollar cost average or should we do a lump sum investment? This is a question on everyone's mind when they start to invest. And this is also today's topic for this video. There are many debates on whether dollar cost averaging or lump sum investment is better. Before I dive in more into dollar cost averaging and lump sum investing, please give an early thumbs up or to subscribe to my channel for me to produce more content for you guys. So firstly, let's define them. So dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. So this means, for example, you have $25,000 and you split it up and invest about $500 per month. So this will mean that the $25,000 will be invested into the stock market slowly over a 4-year time period. On the other hand, a lump sum investment would mean that the $25,000 would be invested straight into the stock market. So there are definitely pros and cons to both strategies, and I'm going to talk about each. So for dollar cost averaging, there are definitely some advantages to dollar cost averaging. So it helps to spread the risk of investing as you're spreading out your investments over a period of time, meaning you're buying both the lows and the highs as you follow the stock market throughout the time period. So this also means that you can take advantage of a market downturn as you will have extra funds on hand and you can increase maybe your monthly purchases amount. And so because you are also investing periodically every month, the emotional factor is also taken out of it. And I would say that DCA is a good way to start if you do not have huge sum of money available, as putting in money consistently is beneficial in the long term. And it is also good if you have a large sum, but you are more of a nervous investor with a lower risk tolerance. So one disadvantage of dollar cost averaging is that the markets tend to go up over time. So this means that if you are able to invest a lump sum earlier, it is likely to do better than smaller amounts invested over a period of time. And this is definitely so because of the market's rising tendency. So next, we'll talk about lump sum investing. So some of the pros is that historically, lump sum investing has a higher chance of outperforming dollar cost averaging because it gives your investment exposure to the market sooner, provided the markets are going up, as you're putting your money to work right away, which takes the full advantage of the market growth. And one disadvantage of a lump sum would be that you might have no extra money to take advantage of a market downturn, as most of your money would have already been lump sum invested into the stock market. So next, I'll be talking about a study on dollar cost averaging versus lump sum investing done by Vanguard. So I'll put the link in the description below. And what this study uses is monthly stock and bond returns in the United States, United Kingdom, and Australia to evaluate the historical performance of each strategy. So for lump sum investing, they assume that US 1 million is immediately invested into a stock/bond portfolio and then held for 10 years. Similarly, 1 million in pounds and 1 million in Australian dollar. So for dollar cost averaging, they assume that the same sum starts in a portfolio of cash investments and is then transferred in equal increments into a stock bond portfolio over a period of 6, 12, 18, 24, 30, and 36 months. So once the dollar cost averaging investment period is complete, the dollar cost averaging and lump sum portfolios have identical asset allocations and both remain invested through the end of year 10. So from figure 1, you can definitely see in terms of the 10-year period for each of the market, the United States, UK and Australia, lump sum investment has definitely provided a better returns. And these three charts show a 60% allocation to the local equity market and 40% allocation to the local bond market. And definitely you can see that the returns are better for lump sum investing. Next, in figure 2, you can see that this is for 100% equity portfolio, 60 equity, 40% bonds, and 100% bonds portfolio in terms of United States, United Kingdom, and Australia. Similarly, we can see that the lump sum investment has performed much better than dollar cost averaging as well. Definitely, the study has emphasized that dollar cost averaging in their context is that it is a more prudent way to invest, and that if you do not have a large sum of money, you can actually make use of dollar cost averaging to transfer a portion of your each paycheck. So, but their research, in contrast, definitely focuses on the strategy for investing an immediately available large sum of money. And the results showed that it has favored lump sum investing. So they are not saying that dollar cost averaging is no good, but it just depends on your strategy and how you are able to invest. So the conclusion of the study is that if the markets are trending upwards, it is logical to implement a strategic asset allocation as soon as possible, because it should offer a higher long-run expected return than cash. And historically, a long-term upward trend has persisted for both equities and bonds, probably attributable to positive risk premium in the market. In other words, positive returns have compensated investors for taking risks, hence the upward trend in markets and the resulting probabilities of success for lump sum investments. So to the extent that an investor believes the positive risk premium are likely to exist in the future, lump sum would remain the preferred method for investing an immediately available large sum of money. But if the investor is primarily concerned with reducing short-term downside risk and the potential for regret, then dollar cost averaging will definitely be a better alternative. So, to conclude the video, which is the better investing strategy? So definitely based on the previous study, research has definitely shown that lump sum investment is better, as your money is going into the stock market straight away. And because time in the market is beneficial, and we always assume that the markets go up in the long run. But if markets are going down and you're wondering if it's the right time to invest, as you're afraid that the markets will continue to fall, this is when dollar cost averaging is for you to take advantage of the drop. Definitely, emotions can also run high if you invest a lump sum at one go. Dollar cost averaging, on the other hand, will allow you to minimize the downside risk in the short term. So all in all, there will be individuals who prefer lump sum or dollar cost averaging. You will ultimately need to know your emotions and know if you can sleep in the night if you are able to take on more risks. So we have come to another end of Singaporean Talks Money, and I hope that you have enjoyed the video today. Do let me know any of your feedback or comments in the comment section below, and please do give a like and subscribe to my channel for me to produce more content. Thank you.